I had $50,000. It was the spring of 2015, and I had a decision to make. Option 1. Use it as a down payment on a rental property, become a landlord, build equity, collect rent, do what my father told me to do for 30 years. Option 2. Buy Bitcoin. At $314 per coin, about 159 Bitcoin, I chose neither. I left the money in a savings account, earning 0.4% while I thought about it for 6 months. And then I put it in individual stocks that I had read about on Reddit. You already know how that story ends. I told you about it in a previous video. But today, I want to show you both paths I did not take. The real math on both of them. Every number, every cost, every tax, every toilet. Because most people who compare Bitcoin and real estate compare the headline return and nothing else. And that comparison is almost completely useless. My name is Donald Cash. Double chin, gold tie. Jerome, who has recently discovered that the gap behind the couch is an acceptable sleeping location. I disagree. Jerome does not care. Today, Bitcoin versus real estate, the real math. And I want to be clear about what I mean by real math. I do not mean the number you see on a chart. I mean the number that lands in your bank account after everything. After the mortgage, after the property tax, after the roof, after the tenant who paid 6 months late, after the capital gains tax when you sell, after the years where Bitcoin dropped 80% and you either held or you did not. That number, the real one, let me run both scenarios, starting with the same $50,000 in the same year and ending in May 2026. Scenario 1, the rental property. It is January 2015. Median home price in the United States, approximately $285,000. Your $50,000 is a 17.5% down payment, close enough to 20% that a lender accepts you. You take a mortgage of $235,000 at a rate of approximately 3.7%. That was a normal 30-year fixed rate in early 2015. Your monthly mortgage payment, principal and interest, approximately $1,080 per month. The house rents for $1,800 per month, a reasonable rent-to-price ratio for a median property in 2015. So, on paper, you are making $720 a month in profit, $8,640 per year. That is the number most people stop at. That is not the real number. Here are the actual costs. Property tax. The national average effective property tax rate is approximately 1.1% per year on a $285,000 property. That is roughly $3,100 per year, or $258 per month. Insurance. Landlord insurance for an investment property averages approximately $1,800 per year, $150 per month. Maintenance and repairs. Industry standard is to budget 1 to 2% of property value per year on a $285,000 home. 1% is $2,850 per year, $238 per month. And here is the one that surprises people. That is your baseline maintenance. It does not include the roof that needs replacing. It does not include the HVAC system that dies in August. It does not include the water heater that fails at midnight on Christmas Eve. The average roof replacement in 2026, $12,000 to $18,000, happens once or twice in a typical hold period. Vacancy. Every property has vacancy periods between tenants during repairs. Industry standard is to budget 5 to 8% of annual rent on $1,800 per month. 5% is $1,080 per year, $90 per month. Property management. If you manage it yourself, your time costs something. If you hire a manager, typically 8 to 10% of monthly rent. At 8%, $144 per month, $1,728 per year. Let me add those up. Mortgage, $1,080. Property tax, $258. Insurance, $150. Maintenance, $238. Vacancy reserve, $90. Property management, $144. Total monthly cost, $2,960. Monthly rental income, $1,800. Monthly cash flow, negative $160. In the early years of this investment, you are losing money every month, not gaining it. I want to pause on that for a moment, because I know what you are thinking. You are thinking, wait, but equity, the mortgage is getting paid down, the property is appreciating. Yes, and we will get to that. But the cash flow reality in year 1 through roughly year 5 of a leveraged rental property purchased at a reasonable price in 2015 was often negative or marginally positive. The people who told you rental properties generate passive income in year 1 were not telling you the full story. Now, let me fast forward. Between January 2015 and the fourth quarter of 2025, US home prices rose approximately 100% nationally. That is according to the FHFA House Price Index, a doubling over 10 years, roughly 7% per year annualized. Your $285,000 property is now worth approximately $570,000. Your mortgage balance, after 10 plus years of payments, approximately $185,000. Your equity, approximately $385,000. You put in $50,000. You got out $385,000 in equity. That is a 770% return on your invested capital. Now, you also collected rent for those 10 years. Even with the negative early cash flow, as rents grew over time and the mortgage stayed fixed, the cash flow likely turned positive by year 5 or 6. Let us estimate a total net cash flow over 10 years after all expenses of approximately $30,000. Conservative but realistic given how the math typically works out. So total value created, $385,000 in equity plus $30,000 in net rental income. $415,000 from $50,000 in 10 years. That is genuinely impressive. Now let me tell you what happens when you sell. Capital gains tax. Your property increased by $285,000. Federal long-term capital gains rate, 15 to 20% depending on your income. Plus state taxes in most states, plus depreciation, recapture the IRS, requires you to recapture the depreciation deductions you took over the years at a 25% rate. A realistic total tax bill on the sale, somewhere between $40,000 and $70,000, depending on your situation and state. After-tax equity, approximately $315,000 to $345,000, plus $30,000 in rental income that was also taxed along the way at ordinary income rates. Net total, after taxes, after all costs, roughly $300,000 to $340,000 from $50,000 net. That is extraordinary. Let me be very clear. That is an extraordinary return. The leverage worked. The appreciation worked. The system worked. Now, scenario 2. Bitcoin. January 2015. Bitcoin. $314 per coin. Your $50,000 buys approximately 159.2 Bitcoin. You buy it. You hold it. You do nothing else. May 2026. Bitcoin. Approximately $76,000. Your 159 Bitcoin is worth approximately $12,100,000. I need to let that number exist for a moment. $12,100,000 from $50,000. That is a 24,100% return. Even after federal capital gains taxes of 20% on the gain, your after-tax number is approximately $9,650,000, $9.6 million, from the same $50,000 in the same 10 plus years. So, the math is clear. Bitcoin won by an incomprehensible margin. Case closed. Buy Bitcoin. Video over. Except, it is absolutely not that simple, and I want to be honest with you about why. Here is what the Bitcoin scenario requires of you. It requires you to buy in January 2015 and hold continuously through the following events. 2018. Bitcoin drops from approximately $20,000 to approximately $3,000, a reduction of 83%. Your $50,000 position now worth approximately $3 million, falls to approximately $480,000. You have lost more than $2.5 million in paper value. In 18 months. Did you sell? Most people sold. Most people sold because a $2.5 million loss is not a number you hold through without extraordinary conviction or extraordinary detachment. 2022. Bitcoin drops from approximately $69,000 to approximately $15,000. 77% decline. Your position, worth approximately $11 million at the peak, falls to approximately $2.5 million. You have now lost more than $8 million in paper value. Did you hold? Again, most people did not hold. The 10-year return on Bitcoin is real, but it belongs to a vanishingly small number of investors who had the psychological architecture to hold through losses that most people would describe as financially catastrophic. I want to be specific about this. The Case-Shiller Home Price Index has never shown a loss over any consecutive 10-year period in modern American history. Never. Bitcoin has shown drawdowns of 80% or more, twice. In 10 years, the real estate return was lower, but it was a return most people could actually achieve, because it is hard to panic sell a house. You cannot check the price every hour. You cannot click a button at 3 a.m. and sell the asset. Bitcoin's liquidity, which is presented as an advantage, is also what makes it psychologically dangerous. You can exit at any time, which means you can exit at the worst possible time. There is a second thing I want to address honestly. The real estate scenario I described involved leverage. You controlled a $285,000 asset with $50,000. Bitcoin has no equivalent to leverage. You own exactly what you bought. The 770% equity return on the real estate investment is partly a function of putting $50,000 in control of an asset nearly 6 times larger. If you had put $50,000 in Bitcoin, you owned $50,000 in Bitcoin. No leverage. If you had put $50,000 as a down payment on real estate, you owned $285,000 in real estate, 5.7 times leverage. This matters enormously when comparing the two. A fairer comparison might be $50,000 in Bitcoin versus $50,000 as equity in a property worth $285,000, and the property comparison absolutely wins on risk-adjusted leverage return. Bitcoin wins on total return if you held. Real estate wins on achievable return for most people, risk-adjusted, with the leverage mechanism included. Let me also address the income argument, because for the audience of this channel, it matters. Real estate generated income during the holding period, eventually positive cash flow, then steady rental income. Bitcoin generated zero income, nothing. Not $1 arrived in your account from holding Bitcoin. For someone building passive income, for someone in their 50s who wants their assets to pay them while they sleep, this is not a small distinction. Bitcoin requires you to sell to realize any value. You cannot live on Bitcoin appreciation without reducing your position. Rental property pays you every month, even with expenses, even in the early negative cash flow years. There are tax deductions, depreciation benefits, and a trajectory toward positive cash flow that has real-world application. This is exactly why I own Bitcoin as a 5% position, not as my income engine. My dividend ETFs are my income engine. My REITs pay me quarterly. My treasury bills mature and reset. Bitcoin is my asymmetric upside bet. The ticket in my pocket that could be worth something extraordinary or could be worth something painful, depending on whether I can hold through the years that would break most investors. So what is the honest answer to the question in this video's title? Which one made more money? Bitcoin, by an extraordinary, almost incomprehensible margin. If you bought in 2015 and held to 2026, which one made more money for more people in the real world? Real estate, because the leverage mechanism amplified returns on invested capital, because people cannot panic sell a house at 3 a.m, because it generates income during the hold period, and because the return, while lower in absolute terms, was achievable by a much larger percentage of the people who tried. The best outcome would have been to do both. 5 to 10% of your investable assets in Bitcoin as an asymmetric bet, the rest in income-generating assets, dividend ETFs, REITs, and yes, potentially real estate if you have the capital, the time, and the stomach for tenant relationships. That is not a clever observation. That is just what the math says when you run all of it honestly. One more thing. The $50,000 I left in the savings account in 2015, 0.4% per year, for 6 months while I thought about it. Then moved to Reddit stocks. By any calculation, the worst performing asset in this comparison is the one I actually chose. My name is Donald Cash, and I contain multitudes of financial mistakes. Jerome has relocated from behind the couch to directly in front of the television at an angle that suggests he has opinions about this video that he will not be sharing. My tie is still tight. And the portfolio is still working. Let the money do the work. In the comments, would you have held Bitcoin through the 80% crash of 2018? Honest answer, no judgment. I want to know what you actually think you would have done, because I think most of us know the answer, and that answer is a big part of the real math. I reply to every comment. Donald Cash, out.